Good afternoon, everybody. Thank you for joining me today. We're going to be talking about tax issues associated with general aviation used in business operations. My name is Stathopoulos. For y'all that don't know me, I'm a state and local tax partner here at Bennett Thrasher, but also practice in some areas related to aviation. I'm also been a private pilot since 2000 or so, and I've always had an interest in aviation. That's kind of what brought me to this webinar today. I appreciate everybody joining me on what's probably your fifth or sixth webinar of the day, so I'll try to keep this interesting and moving along at a good clip. And with that, we'll just get right into the materials. So the reason we're having this talk today is the COVID-19 epidemic has created some unique opportunities for business aviation. It's a combination of security issues related to the COVID-19 environment, which make general aviation a little bit better suited in some instances to business uses than commercial aviation, as well as certain law changes related to the CARES Act, which was passed in response to the COVID-19 epidemic. So those have created some opportunities for general business aviation that might cause some companies to take a fresh look or re-examine what they've been doing. So a couple things about this presentation today. One, we're only going to be talking about tax issues. So I'm not going to be talking about the federal aviation regulations and what constitutes an illegal flight department under FAR Part 91 or Part 135. We're not going to be talking about federal excise tax today on transportation. We're going to be talking about selected Internal Revenue Code and state and local tax issues. And there'll be an opportunity at the end for people to ask questions. So we're going to ask that people hold their questions until the end, and then they can send them in via the chat function. So we'll start with some of the federal income tax considerations. And we'll go through federal, then we'll go through some state tax issues, and then we'll talk about some structuring considerations. So as I go through this presentation, I'll keep referring back and forth on issues that kind of cross-correlate to create some structuring issues. We're going to start the first topic with maximizing depreciation. So one of the first things that attracts people to purchasing an aircraft, besides the utility of it, is the ability to claim bonus depreciation. So the Tax Cut and Jobs Act of 2017 allows for 100% bonus depreciation on both used and new aircraft purchases. Prior to that, it was only on new aircraft purchases. When we're talking about used aircraft, it's aircraft that hasn't really been used before by the taxpayer or its affiliates. In addition, we're going to be talking about an opportunity related to the CARES Act, which I alluded to earlier, which has basically deferred the excess business loss deduction for people that are members of pass-through entities, and which allows losses to be carried back by members of pass-through companies like S-Corps and LLCs. It allows carryback of excess losses as well as carry forward, and so the confluence of being able to take bonus depreciation and maybe being able to carry losses created by that bonus depreciation backwards creates some unique opportunities for this year. So once again, under the CARES Act, the excess business loss deduction rules have been deferred. Losses incurred after 1/1/17 and before 1/1/21 can be carried back to each of the 5 previous taxable years, and without the 80% limitation that would otherwise exist. Before we get into maximizing bonus depreciation, in general, aircraft depreciation and operating expenses are generally deductible as business expenses, but you have to meet the requirements of Section 162, which means those expenses need to be ordinary and necessary and reasonable. And things that the IRS looks at are things like, what is the company's need for transportation, especially the utility afforded by general aviation. So for instance, if you look at some of the cases historically around this, where the IRS has disallowed aircraft expenses as not being ordinary and necessary. They tended to look at situations where maybe there was a single business office of a taxpayer and all their customers were local, and there was really no need to engage in interstate or intrastate air travel to serve the airline, the operating business's needs. The other things they look at is the relative cost of the aircraft, the other assets of the company, the extent to which the company can bear the expenses. Obviously, anything that's going to cause a company to permanently go into losses would be something they would look at. The degree to which the aircraft is used in a business-like manner versus personal use. But in general, to sum up kind of the cases out there, you just have to establish a real-world demonstration that the aircraft serves a need for the business that couldn't otherwise be met by by commercial aviation. So one of the unique opportunities associated with COVID-19 is now there are many more arguments for why business aviation might be preferable over commercial aviation, including security of the employees, less risk of exposure to COVID-19. So it just kind of buttresses some of the reasons why general aviation or business aviation might be an alternative. Accelerated depreciation and bonus depreciation have been around for a while. I'll skip to the Tax Cut and Jobs Act of 2017 that established bonus depreciation of 100%, and that's what we're going to be focusing on today, for assets placed in service or purchased between September 28, 2017 and December 31st, 2022. After that, the bonus depreciation begins scaling down 80%, 60%, 40%, and finally 20% in 2026. So the opportunity to claim bonus depreciation is what we're going to initially focus on, and some factors associated with whether we'll elect that versus taking makers. The maker's depreciation schedule outside of bonus depreciation depends on the asset class or recovery period of the aircraft. In general, for business aviation, what we're going to be talking about today, corporate aircraft, it's generally a 5-year maker's recovery period and a 6-year asset life. To the extent that aircraft are used in commercial transport, for instance, under Part 135, then they have a 6 years maker's recovery period. The most important things are you have to meet certain tests in order to qualify for bonus depreciation under IRC Section 280F. The most important of those are the aircraft has to be used at least 50% incidental to the business of the entity. And also, it has to be predominantly used in the U.S. or not predominantly used outside the U.S. The 50% test is a little bit complicated. So although it's a 50% business use test, there's also a 25% test associated with that test, which basically says of that 50% business use, no more than 25% can be related to the following activities. One is leasing of the aircraft to a 5% or greater owner of the taxpayer or related person. And as we're going to get into later, there's a very common structuring desire of owners of especially closely held and pass-through businesses to put aircraft into business entities other than the operating company and off to the side. And if not properly structured, these leases can create a risk to the 50% qualified business use test. Another one is the usage of the aircraft to provide compensation to a 5% or greater owner of the taxpayer or related person without reimbursement. Finally, the last one is use of the aircraft to provide compensation to any other person where you don't include that amount in their gross income as a fringe. And we're going to talk about the simple rules in a little bit. So the bigger point is that in order to meet the 50% test, there are structuring considerations you have to take into account. So for example, you could use an aircraft 75% for business use, but still fail that test if you don't meet the 25% qualified business use test. So one of the things to look at when trying to decide if you're going to take bonus depreciation is the personal use of the aircraft, especially in the first year that the aircraft is placed into service. So while we're under 100% bonus depreciation, it might be useful to try to defer personal use of the aircraft and/or defer when the aircraft is purchased in order to ensure that you get the maximum depreciation and minimum disallowance of depreciation related to personal use of the aircraft. So for that reason, it might be advisable to purchase an aircraft near the end of the tax year in order to better control the business versus personal use. To give an example, a taxpayer purchases an aircraft in November of year one, and they're not going to have any personal use because they structured it that way. They knew they wouldn't need to make any personal flights until January of the next year. They elect to claim 100% bonus depreciation. Then in years 2 through 6, they plan to have significant amounts of personal use, let's say up to 49%, the maximum allowable amount. So here, because the aircraft has been subject to 100% bonus depreciation in year one, in years 2 through 6, there's no longer any disallowance on depreciation related to the personal use of the aircraft. So as long as the aircraft remains in use business use 51% of the time, otherwise there could be a recapture. So the point is, by being careful with structuring personal use in year one and deferring it until years 2 through 6, the taxpayer here was able to avoid a 49% haircut on their depreciation in year one, and with no penalties in years 2 through 6. Another example, taxpayer purchases an aircraft in January of this year and elects 100% bonus depreciation. So this taxpayer did not do any planning, and their personal use of the aircraft is 49%. So just to compare and contrast with last time, now the taxpayer has to disallow 49% of the year one depreciation. However, there is a planning opportunity, which I'm going to get into a little bit later, which is you can actually choose to take the disallowance for personal use from depreciation based on the straight line method versus makers. And so although you might claim bonus depreciation or makers depreciation on the aircraft, you don't necessarily have to take the personal use disallowance on that. You can actually take it on straight line depreciation. But we'll talk about that later. So in this example, in years 2 through 6, their personal use declines. So let's say it goes down to 25% per year. So in this case, the taxpayer lost a significant amount of their depreciation in year one by trying to do bonus depreciation, and they might have been better off electing to just take makers instead, or defer the purchase of the aircraft until later in the year. Next, we're going to talk about personal entertainment disallowances. So aircraft can be used for personal use, business aircraft. However, there are certain requirements related to that. And we're going to start with Section 61. Section 61 basically requires that individuals who get personal use of business aircraft have to recognize that benefit as a fringe benefit in their taxable income, or if they don't reimburse the company. And reimbursing the company creates many problems, and I'm not going to get into federal aviation regulation issues because that's not an area I practice in, but reimbursement of flights can create a compensation for hire situation where the aircraft is deemed to be an illegal flight department and could cause very high penalties from an FAA perspective and potentially trigger federal excise tax on unintended transportation company. So for that reason, it's usually preferable that the individuals not reimburse the company for personal use of aircraft and instead recognize income and withholding on the benefit they receive from the personal flight. So SIFL, which I'll keep calling the standard industry fare level, this is a formula that's used by the IRS to basically estimate what the fair market value of personal use of flight time would be. And you have to include that in the affected individual's W-2 or 1099 or K-1, what have you. And failure to do so, and this is the important part, can result in disallowance of those expenses under 274. So you could lose possibly 100% of the depreciation operating expenses. So another change that happened with the Tax Cut and Jobs Act is business entertainment is now, or any entertainment use of the aircraft is now a disallowed expense. So if you're a sole proprietor, you generally are not going to use the per seat method of tracking whether something is business personal versus business. So you're gonna do it on the basis of each flight. For an employer-provided aircraft, you're generally going to do a seat-by-seat calculation. It's also possible to use flight-by-flight, but you're generally going to use a seat-by-seat method. And so in general, your allocation for personal deductions are going to be disallowed, while allocations for personal non-entertainment can still be deducted. So let me kind of repeat that one more time. Business use of the aircraft is obviously deductible, and personal use of the aircraft is deductible. Entertainment use of the aircraft, whether it's for business or non-business, is not deductible. And under the SIPL method, certain highly compensated or key management employees, called control employees, get imputed a higher level of compensation. So to break down everything into kind of the categories that exist now post TCJA, we have business non-entertainment. So that's obviously all expenses are deductible and there's no need to attribute any income to any individual. Then you have business entertainment. As I said, entertainment is no longer something that can be deducted. So any of the expenses associated with those entertainment, even if they're business entertainment flights, are now non-deductible, and you have to apply SIPL to impute income to individuals that are on that flight. Personal non-entertainment, as I said, are still deductible as long as you apply the SIPL imputed income charges. And then finally, personal entertainment. Once again, anything entertainment related is non-deductible, and you still have to apply the SIPL charges. This relates to, I mentioned earlier that there's a planning opportunity to take a disallowance of depreciation on the straight line method versus makers or bonus. So once again, if a taxpayer elects this method, you only have to remove depreciation related to personal or entertainment use of the aircraft, under the entertainment use of the aircraft under the straight line method. So if you do this the right way, you can basically take bonus depreciation for purposes of depreciating the aircraft, but limit the disallowance related to entertainment expenses using straight line. I'm going to briefly talk about some of the issues that tend to come up. Besides ordinary and necessary and reasonable, one of the issues that comes up a lot of time for aircraft that are held in a special purpose entity are hobby loss limitations. So the hobby loss rules under Section 183 basically say that if you have an entity that is generating losses consistently year over year, eventually the IRS may take the position that it's not really a business. And therefore, although you have to recognize any income generated by that activity, you can't use any losses generated by that activity except against hobby income. So you can't take it against business income. Generally, if you fail to show profit for 3 consecutive tax years, you could become a target where the IRS tries to determine whether you're a hobby or a business. If it is a hobby, once again, the losses are not going to be deductible, even though you're still recognizing the income. There's a 9-factor test to determine if something is a hobby. That includes the manner in which a taxpayer carries on the activity, professionally or amateur, whether there's any expertise, including advisors that the taxpayer has, the time and effort expended by the taxpayer and their advisors, expectation of future profits. So one of the main defenses against the hobby loss rule is to argue that, hey, every startup business incurs losses and we have expectations of profits in future years. I won't go through all of them, but basically they look at the overall situation, including the element of personal pleasure or recreation. So once again, the more the aircraft is used for non-business purposes, kind of the more helpful it is to the IRS to argue you're not really running a business. The reason this comes up is, especially in the area of closely held businesses, a lot of time, and we're going to talk about this later, the owners of the business either don't all need an aircraft, so not every owner agrees, or they do all agree but don't want the aircraft in the operating company for risk purposes. So they want to move the aircraft over to the side or have it be in a regarded entity underneath. It's usually to the side to avoid liability. And the problem with this is the special purpose entity off to the side may be generating losses, but then there's an inability to match those losses up against the operating income. So one way to get around this is to make a grouping election where you can group the special purpose entity leasing business with the operating business. But in order to do so, you have to meet certain requirements, including common ownership. So one of the things I see a lot of the time is you'll have a special purpose entity that not all the partners or members want an aircraft, only one does, and so they'll put it off to the side, and that can make a grouping election difficult for the special purpose entity that's holding the aircraft. But we'll get more into structuring in a little bit. Another one that constantly comes in with special purpose aircraft entities off to the side or improperly structured underneath the operating company are the passive activity loss rules. So rental activity is per se a passive activity, and you have to be able to show material participation and other factors to get around this. So once again, you can have a special purpose entity that's leasing the aircraft to the operating company, and any losses generated by depreciation taken by that company or by the operating expenses of that can end up being limited under the passive loss rules. Like the hobby loss rules, it is possible to make grouping elections annually to try to group the operating company with the special purpose entity, but like with the hobby loss rules, there are limitations, and if the ownership is different and the two businesses aren't really part of one unit, it may be difficult to get a grouping election. Other issues, we talked a little bit about the net operating loss carryback issue for this year under the CARES Act. The partial deferral of the excess business loss rule is going to be reinstated next year. So if you were going to purchase an aircraft to try to take advantage of the carryback benefits, that would be something that would need to be done before December 31st. Leasing structures, we're going to talk more about. Leasing structures provide a lot of benefits, including deferral of state and local sales use taxes, but they also can cause FAR and excise tax problems. And obviously, there are international tax issues for aircraft used internationally and federal excise tax issues that we're not going to discuss in this presentation. So before I go into structuring, I'm actually going to skip ahead to state tax considerations, and we'll go back to structuring in a moment. So in general, aircraft are tangible personal property, which is deemed to be subject to sales and use tax. And it's relatively easy to avoid sales tax on an aircraft by where you take delivery. So keep in mind, sales tax is imposed on a seller when they make a sale of tangible personal property to somebody in a state and the seller has nexus in that state. So it's very easy to avoid sales tax by taking delivery of an aircraft in a state that either doesn't impose sales tax on such transactions or has a cap on such transactions, or which has a liberal fly-out rule. So just to give some examples, South Carolina limits its sales use tax on aircraft to $500. North Carolina, their sales and use tax cap on aircraft is $2,500. Florida has a rule that as long as an aircraft remains in the state less than 21 days, you then fly it out, that's not going to trigger tax. And furthermore, they have a rule that if you buy an aircraft outside the state and you're a non-resident and it remains outside the state for 6 months or more, then it's exempt from use tax when you bring it into the state. And they also don't tax fractional ownerships. The point of all this is that it's easy to avoid sales tax, but it's hard to avoid use tax. So most states have something called a compensatory use tax. And what that is it's a tax that's imposed on the buyer's first use or storage of tangible personal property in the state where the buyer did not pay sales tax for whatever reason, usually because the seller doesn't have nexus in the state and was not required to collect sales or use tax. Or in this case, it could be because delivery of an aircraft was taken outside the state. Avoiding use tax is much more difficult. State departments of revenue have become much more sophisticated in tracking aircraft purchases. I can only speak to the Georgia Department of Revenue, but the Georgia Department of Revenue tracks the FAA registration database. And anytime there's an aircraft purchase where there's a Georgia address in the FAA database, that kicks out a notice from the Rome office of the Georgia Department of Revenue, Rome Regional Office, and they send out a letter saying, where's our sales and use tax? And there are some answers that you can reply to that. Staying on the general aviation side of things, it is possible to defer sales tax or use tax on an aircraft purchase, but it's hard to avoid it completely. There are periodic instances where you might be able to do that permanently, but in general, what you see a lot is people purchase the aircraft in a special purpose entity and then lease that aircraft back to the operating company. In order to avoid FAA problems, it's a dry lease where the special purpose entity is not providing any of the pilots or any of the other maintenance of the aircraft. That's all being done, not maintenance of the aircraft, but the pilots and operation of the aircraft is up to the operating company. The problem with all this is sometimes when you're trying to defer sales tax or avoid sales and use tax, you can end up being in conflict with some of the federal income tax provisions I cited earlier. So you have to make sure that you engage in structuring that accomplishes both goals, and we'll talk about that in a minute. But if you do it right, then when you initially purchase an aircraft, whether in Georgia or outside the state, if the aircraft is going to be used exclusively in leasing activities or demonstration activities, then the initial purchase of the aircraft is actually exempt from sales and use taxes. And those can be pretty steep. So I think the highest sales and use tax rate in Georgia is around 8.5%. So if you impose that on $1 million aircraft, that's a material amount of tax. Whereas if you engage in a leasing structure, you can avoid that initial sales or use tax. And instead, the tax is imposed on the periodic lease payments. So the special purpose entity that is dry leasing the aircraft to the operating company is going to register as a dealer and collect sales tax on the periodic lease payments. In terms of what is a reasonable rate of rental, the Department of Revenue rarely gets into valuation considerations like that, but obviously it would need to be some kind of reasonable rental rate. Although this is a great deferral, in the long run, if an aircraft is kept long enough, it's conceivable that the tax on the periodic leases might exceed the use tax that would have been paid on the initial purchase of the aircraft. So it's something to look at. But as I said before, if you structure it the wrong way and you use an entity off to the side or you use a regarded entity inappropriately, that can cause problems with your 50% business use test under Section 280F or create hobby loss or passive loss limitation rules. Could also result in FAA action, once again, if you improperly structure a leasing activity such that it's not really a dry lease and it looks like operational control of the aircraft is in the hands of the leasing company. That can generate very significant FAA action and or trigger federal excise tax liability. So with that being said, we'll go back up to structuring. So the simplest way to structure an aircraft purchase is just put it in the operating company. Then, assuming it meets the 50% test, all the depreciation and operating expenses of the aircraft can be netted directly against business income. The downside to that is that the aircraft, any risk associated with operation of that aircraft is directly in the operating entity. Now that can be arguably insured against, but I know that that's an issue that companies and their counsel look at. Another downside is there's no sales or use tax benefit in this instance. Because the business purchased the aircraft, it's going to be subject to either sales or use tax upon the first use of the aircraft, assuming it's going to be located in a state that imposes sales or use tax on aircraft like Georgia does. As an alternative, you'll sometimes see aircraft held in what I call a sidecar entity. So this is a special purpose entity that's typically held off to the side by one or all of the owners of a business, and usually it's a pass-through entity for closely held businesses. And then the special purpose entity dry leases that aircraft to the operating company, and the special purpose entity is typically a regarded entity. So you have one regarded entity leasing the aircraft to another. Part of the problem with that is, once again, the 25% of the 50% business use test under Section 280F can be triggered. So because those entities are related, it may result in a loss of your ability to take depreciation of the aircraft. And in addition, as I mentioned before, to the extent that ownership of the special purpose entity and the operating company are not the same, you can result in having trapped hobby losses or passive losses in the entity. So the upside of all this is that you do get the sales use tax deferral benefit. So the special purpose entity, to the extent it purchases the aircraft, takes an exemption from the initial purchase from sales tax, and then takes a deferral benefit and only has to pay sales use tax on the lease payments, assuming the aircraft is located in a state like Georgia or a similar state. Another upside is the operational risk is not directly in the operating company, so you're not exposing the operating company or its profits to aircraft operations risk. But there is, once again, illegal flight operation risk if not structured correctly, and that's an issue for Aviation Council to address. Another example that solves some of these problems is you have a regarded business entity, the operating company, and they hold the aircraft in a single member LLC underneath the operating company that's disregarded for federal and Georgia income tax purposes. And then once again, that special purpose entity, which is disregarded, dry leases the aircraft to the operating company. The good news about that structure is most states follow the federal tax treatment of entities. So for instance, in Georgia, that single member LLC will be disregarded and there will be no lease. So even though there's functionally a lease there for sales use tax purposes or other legal purposes, there is no lease for federal income and Georgia income tax purposes, thereby avoiding the 50% business use rule trap and the hobby loss and passive loss limitation rules. Meanwhile, you still get the sales and use tax benefit because in Georgia, for instance, and a lot of other states, for sales and use tax purposes, the state may not follow the elective entity classification rules. Those may only apply for income tax purposes. So in this example, if the aircraft were based in Georgia, you still get the sales tax deferral benefit without causing any issues for federal and state income tax purposes. And once again, you've managed to keep operational risk not directly in the operating company, but in a separate limited liability entity. All right, so with that, I will open up the discussion to any questions. All right, let's see here. I'm trying to open up chat here. So one question is, what other options are available besides purchasing an aircraft? Obviously this presentation has been about the purchase of aircraft, either by the operating company or an affiliated entity. There are multiple other forms of using aircraft, including leasing, fractional ownership, joint ownership in common, but those are all issues that should be discussed with Aviation Council, all have slightly different tax consequences. Another question is, what kind of records am I required to keep to claim applicable tax deductions? And here, unfortunately, voluminous record keeping is required. Referring back to the standard industry fare level rules I mentioned earlier, in general, a business is going to be required to keep really detailed logs, not only for the purpose of the flight, and compliance of the flight with the company's flight operations provisions, but also tracking for each seat, whether that flight is business, personal, deadheading, other. So, that is something to check in with. And because the rules change fairly often, it's very important, even if you have established aircraft operations, to check in with your tax advisors at least annually to see if there's been changes to any of the rules. Let's see here. Let's see. Are business use requirements determined per entity in a fractional ownership structure? I think the answer to that is yes. But I'm not positive. So I will likely do another one of these where I have Aviation Council as co-speakers, and we'll get more into some of the different flavors of ownership, including fractional ownership of aircraft. All right, one of the questions is, I would like more commentary around the 25% business use for related parties. Maybe an example of how that affects the owner. Sorry, hold on. Lost the question, just a second. Well, I lost the question. So going back to the 25% rule, just to talk about that a little bit more. Once again, you could use an aircraft 90% for business reasons, but still fail the test if, let's say, you've got half of the operations, let's say more than 25% of that 90% is related to a lease. So let's say you set up the company as a sidecar, and you've got a dry lease and it's a regarded entity. Because that lease is deemed to be one of the activities that can't make up more than 25% of the 50% of business use, you could still fail the business use test under 280F and therefore lose the ability to depreciate the asset. Not sure if that addressed the question. Would you guys have a similar webinar regarding fractional ownership? I think we will. So as I said, I think there's a lot of the questions relate to alternative ways to own aircraft, including fractional ownership and joint ownership. So I think we will do a follow-up and address the tax implications, including state and local tax implications, and including property tax implications of fractional ownership. And so yes, we'll do that. Let's see here. If we lease the aircraft in a state that exempts aircraft like Massachusetts, but uses the aircraft periodically in a state like Georgia, do we need to accrue use tax on the periodic use in Georgia? So that's a complicated question. The answer is maybe. Some states have specific rules for aircraft in terms of how many days you can spend in the state before you trigger use tax. Georgia does not. So arguably, a single day of use in Georgia of an aircraft could conceivably subject you to sales and use tax. It likely wouldn't, obviously, from a practical perspective, because I don't know how the Department of Revenue would ever track that. And I don't think they track flight tracking software. But if you did use an aircraft, a material amount of times in Georgia, what Georgia Department of Revenue would say is, all right, you owe use tax, and we'll just give you a credit against any sales tax you paid to other states. So if you initially purchased or leased the aircraft in a state that doesn't have a sales tax, then there's no impediment to a state like Georgia imposing use tax on the use in Georgia. But it's good to look and see if a state has a specific safe harbor, and if it doesn't, I would just say it's something to be wary of. But once again, as a practical matter, I'm not aware of the Department of Revenue performing ramp checks or using flight tracking software, so it's unlikely that they would come after you. I think other states do track flights using flight tracking software and/or do ramp checks more often, and you might be more at risk in a state like that. Let's see here. Are there any adjustments to personal non-entertainment usage in 2021? Excuse me. No, the only difference is that the limitations that the CARES Act imposed on excess business losses go away in 2021. Are slides available to the attendees? Yes, we'll make sure that any of the attendees can get copies of these slides. Where I think I would like to end it, if there's not any more material questions, is this is an extremely complex area of law, and we have professionals in Bennett Thrasher that perform these standard industry fare level calculations and perform all the record keeping associated with business use of aircraft. And it's probably a good idea, due to the complexity of law, to have a more detailed conversation with your tax advisor and your aviation counsel before entering into any kind of business use of aircraft. And if you have been doing something for a few years and haven't checked in, it might be a good idea to check in with counsel and tax advisor to see how the changes in law, including the recent CARES Act and TCGA, would affect those operations. And so with that, I'm going to end it a little early because this is actually my third Zoom call of the day, and so I appreciate everybody joining in. And as I said, we'll have a follow-up presentation on alternative means of owning aircraft. Thank you.